When I first began in this game, the hardest thing for me to learn was this: the market doesn't care what I think. The tape doesn't care if I believe a stock is cheap or if I think it's due to rise. My opinion isn't worth a dime compared to the verdict of the market. That's a truth most traders never accept. They think they can argue with price, and what happens to a man who argues with price? He ends up broke. Do you see the sense in that? You can make 1,000 trades and get nowhere if you don't understand one simple law. Cut your losses short and let your profits run. I didn't invent that line. The market taught it to me with a whip in its hand after I'd been too stubborn to obey. You cut your losses short because a small loss is the best loss you'll ever take. It's tuition paid to the market for the right to keep trading tomorrow. But you let your profits run, because the big money, the only money that really counts, is made by sitting, not by fidgeting. Ever notice how a stock that starts moving in your favor often keeps on moving? Do you grab it too early, afraid to lose what you already made? That's the ordinary mistake, taking small profits quickly and nursing big losses endlessly. Reverse that, and you stand a chance in this game. Reverse it, and you're thinking like the tape, not like your emotions. But tell me, how many men do you think can really reverse their nature? Not many. That's why this business is cruel. I used to believe I was smart enough to outguess the market. I thought if I just stared at the ticker long enough, I could will the price to bend my way. You ever felt that? You put your money down, and suddenly you're praying. Not trading, praying. Hoping the stock moves because you need it to. But the market doesn't care about your prayers. It punishes hope and rewards discipline. Do you see why? Now, when I say cut losses, I mean fast, merciless, without hesitation. You buy a stock, and it starts to sag, not rise. That's all you need to know. Something's wrong. Maybe the whole market is weak. Maybe the stock isn't ready. Maybe you misread the chart. Whatever it is, the only cure is to get out. A small loss today won't hurt you, but a big loss tomorrow can cripple your account, and worse, your confidence. Ever had a loss so heavy it paralyzed you, where you couldn't even place the next trade because the wound was still bleeding? That's the danger of failing to cut. And when I say, let profits run, I mean you must fight every instinct that screams for you to grab that money. The ordinary man wants to take a profit as soon as it shows up. He sees a few points in his favor, and he snatches them like a beggar grabbing crumbs. But crumbs never made a fortune. The real moves, the ones that matter, can last weeks, months, even longer. If you're right, the market will reward you beyond your imagination, if only you have the patience to sit. But let me ask you, are you patient enough to sit still when the whole world is shouting at you to sell? Charts will show you the way. Not tips, not rumors, not some broker's chatter. The tape writes the truth in black and white. If a stock breaks out of a base, moving on volume, that's strength. If it holds its gains through pullbacks, that's character. And when you see that, you mustn't be content with pennies. You must sit for dollars. How else will you ever build wealth in this game? Most people come into the market looking for action. They want excitement, the thrill of the gamble. But action costs money. Discipline makes money. Are you here to gamble, or are you here to build a fortune? Because the two roads do not lead to the same place. Let me tell you what I learned in my early bucket shop days. Back then I was just a boy with a sharp eye for numbers. I noticed patterns in the way prices moved. I could tell when a stock was about to shift direction, just by reading the tape. I'd make a quick bet, take my profit, and move on. It worked for a while. But when I stepped into the real market, I learned a harder lesson. The big money wasn't in catching every little fluctuation. It was in catching the big swing and holding it. That's where let profits run became a law, not a suggestion. I remember a time I bought a stock that looked strong as a bull. It went up a few points, and I felt like a king. Then it dipped, and I panicked. I sold for a small gain, proud of myself for being safe. But the next day, the stock kept climbing, and the day after that. Before long it doubled, then tripled, while I was out of the game with a measly profit. Do you know what hurt worse than a loss? Watching a missed fortune run away without me. That's when I vowed, Never again would I be satisfied with crumbs when the loaf was on the table. But here's the paradox: holding a winner is harder than cutting a loser. Think about that. Cutting a loser only takes courage once. Holding a winner takes courage every day, because every tick against you feels like it's stealing your profit. Every newspaper headline, every whisper in the crowd tries to shake you out. Do you have the steel to ignore them? When I look at a chart, I don't see just numbers. I see a crowd of men, their hopes and fears printed on the tape. When a stock breaks to new highs on strong volume, it means the crowd is buying and buying hard. That's a tide you want to ride. But tides don't turn just because you've made enough to satisfy yourself. They turn when the market decides. The hardest thing in trading is to let the market, not your nerves, tell you when the move is done. Ever closed a trade too soon, only to watch it double without you? That's nerves, not trading. And when the time comes to sell, the chart will tell you. You'll see weakness, lower highs, fading volume, failure to rally. That's when you take your profit, not because you feel like it, but because the tape says so. Discipline, not desire, is your weapon. Money management is another thing tied to this law. You can't let one loss destroy you. You size your trades so that even if you're wrong 3 times in a row, you're still in the game. That way, when the big winner comes along, you're alive to catch it. Cutting losses keeps you in business. Letting profits run pays for the business. Together, they are the foundation. But let me ask, how many traders do you know who live by that foundation? Most ignore it, don't they? And where are they now? Wealth in trading doesn't come from one lucky break. It comes from consistency, following the same rules day after day, trade after trade, no matter what your emotions say. Emotions will trick you every time. They'll tell you to hold the loser a little longer, because it'll come back. They'll whisper that a profit today is better than a bigger one tomorrow. But emotions don't pay. The tape pays, and the tape pays only the disciplined. When I was making my fortune, people thought I had some secret. But there was no secret, just this law. I cut my losses quick, without mercy. I let my winners run until the market itself threw me out. That's all. It sounds simple, doesn't it? Yet, if it's so simple, why don't more men do it? Why do they keep falling into the same trap of grabbing small gains and hugging big losses? Because human nature never changes. A man hates to admit he's wrong. Cutting a loss is admitting you were wrong, and most men would rather be broke than wrong. Am I right? But the market doesn't reward your pride. It punishes it. And the man who refuses to cut his loss is the man who won't last. I've seen traders hold on to losing stocks for years, waiting for them to come back. But a stock doesn't know you own it. It doesn't care about your cost basis. It goes where it goes. You can tie your fortune to it if you like, but that's not trading, that's wishful thinking. And wishful thinking is poison in this business. When you hold on to losers, you tie up capital that could be working for you in winners. Think about it, every dollar stuck in a dead stock is a dollar you can't use to ride a strong one. Isn't that a double loss? You lose not only the money in the bad stock, but also the opportunity in the good one. Cutting losses isn't just about defense, it's about freeing your capital for offense. And when you let profits run, you do more than grow your account. You grow your confidence. You prove to yourself that you can sit through the noise, that you can trust the chart, that you can stand apart from the crowd. That confidence is worth more than the money, because it makes you a stronger trader with every win. Tell me, what's the use of making a few dollars if you lose your nerve every time? The greatest fortunes in Wall Street were never made by men who scalped pennies. They were made by men who had the vision and the nerve to hold on through entire moves. The great swings, the bull markets, the bear markets, those are the waves you ride to wealth. And you can't ride them if you're always jumping off at the first bump. Can you imagine a sailor who abandons ship every time the sea gets rough? Would he ever reach port? I'll tell you straight, there's no way around this rule. If you can't cut your losses, you'll bleed to death. If you can't let profits run, you'll starve on scraps. The market is merciless, but it's also fair. It gives the same law to every man. And only the men who obey survive. Do you think you're the exception? Losses are tuition to the market, small fees keep you in the game, big ones take you out. That single line holds more truth than all the market chatter and predictions you'll ever hear. Every trader who has lasted long enough in this business has paid that tuition. You can't avoid it. You can't bargain with it. The only choice you have is whether you'll pay a small sum and keep learning, or whether you'll be reckless and pay so much that you're forced to quit. Think about it. When you step into any other profession, don't you invest in education, training, practice, and tools? Why should trading be any different? The market is the greatest school in the world, but it charges tuition in losses, and it charges without mercy. When I first started, I didn't understand this. I hated to lose. I took every losing trade as an insult, as if the market had called me a fool. But the market wasn't insulting me. It was teaching me. The problem was that I didn't want to be taught. I wanted to be right. Have you ever felt that? That burning need to prove your opinion correct, even as your account balance proves you wrong. That is pride talking, and pride is the most expensive tuition of all. Small losses are not enemies. They are the cost of staying in the arena. When you put on a trade, you are making a bet, and not every bet will win. In fact, many will lose. But as long as those losses are cut short, they are survivable. They are no different from a business expense, like rent or salaries. If a store owner spends money on rent, does he curse the landlord? No, he accepts it as the cost of doing business. The trader must learn to treat small losses the same way. They are the rent you pay to the market for the chance to profit. But how many traders treat them that way? Most see them as personal failures, and so they hold on, hoping the market will reverse and let them escape without pain. Do you know what happens then? The small rent turns into a crushing debt. There's a saying I've always believed: you don't lose because you're wrong, you lose because you stay wrong. A wrong trade cut quickly is just a scratch. A wrong trade held too long becomes a wound that festers. One scratch won't end your career, but a festering wound will cripple you. The reason small losses are tuition is because they teach you how to recognize when you're wrong. They remind you that you're not here to be right, you're here to survive and profit. The man who thinks he must be right every time is doomed. The man who knows he will be wrong often, but wrong small, has a chance. Which one are you? Big losses take you out, and not just financially. They take you out mentally. You can recover money faster than you can recover confidence. After a heavy blow, most traders lose their nerve. They hesitate on good trades, or they overtrade trying to win it back, or they abandon their rules in desperation. Have you ever seen a trader chasing his loss like a gambler doubling down at the table? That's the road to ruin. The only cure is never letting the loss get big in the first place. Small losses are painful, yes, but they don't scar you. Big ones leave marks you never forget. I remember one trade early in my career where I thought I was smarter than the tape. The stock dipped against me, and every instinct told me to cut it. But I refused. I told myself it would come back. I convinced myself I was right. Days turned into weeks, and the loss grew until it was so large that I couldn't bear to sell. Do you know what happened? The stock kept falling until I was forced out, not by discipline, but by desperation. That loss wasn't just money, it shook me to the core. It was a lesson that never left me. Cut the loss when it's small, or it will cut you when it's large. Think about the mathematics of it. If you lose 10%, you need 11% to get back to even. Lose 50% and you need 100% just to break even. The deeper the hole, the harder it is to climb out. That's why small losses are manageable, while big ones bury you. The market doesn't care about fairness. It doesn't care that you worked hard for your money. If you give it the chance, it will take everything. The only protection you have is the discipline to cut when you're wrong, to pay the tuition, and move on to the next lesson. The curious thing is that once you accept small losses as normal, they stop hurting. They become routine, like a doctor washing his hands before surgery. You place a trade, you set your stop, and if the market says you're wrong, you step aside. No drama, no pleading, just another day at the office, and that calm acceptance keeps you in the game. The man who cannot accept small losses will never last long enough to catch the big profits. Isn't that the truth? Look at the great traders who came before us. None of them avoided losses. Every one of them lost money, sometimes frequently. The difference is, they refused to let a small loss become a disaster. They learned, adjusted, and pressed on. That's why I say small losses are tuition. Each one is a lesson in humility, in risk control, in patience. You learn what not to do as much as what to do. And sometimes, learning what not to do is the more valuable education. There's another side to this too. When you treat small losses as tuition, you free yourself from the fear of being wrong. Fear is what makes traders freeze. Fear is what makes them hold losers until they grow monstrous. But if you truly accept that losses are part of the process, what's left to fear? You stop worrying about being wrong and start focusing on being disciplined. And discipline, not prediction, is what builds accounts. Do you see how powerful that shift is? I've always said the market is never wrong, but opinions often are. Your opinion may feel brilliant. Your reasoning may sound airtight, but if the market disagrees, you will pay. That payment is your tuition. The quicker you pay, the cheaper it is. Refuse to pay, and the debt grows with interest. And the market is a ruthless collector. It will take every last cent if you let it. What happens when a trader finally learns this lesson? He stops tying his identity to each trade. He no longer feels the need to be right all the time. He stops chasing the thrill of the win and starts chasing the discipline of survival. He sees each small loss not as a defeat, but as the cost of doing business. And because he keeps those costs low, he lives to catch the rare trades that make the whole game worthwhile. Isn't that the kind of trader you want to be? The market doesn't care about your dreams, your hopes, or your ego. It only respects discipline. Cutting losses is the first act of discipline. Accept them, even welcome them, because they prove you have the strength to follow the rule that keeps you alive. They prove you're willing to learn. And as long as you're willing to learn, you're still in the greatest classroom in the world, the market itself. Cutting losers frees capital to ride stronger trades. That principle is as hard as iron, and yet most traders break it every day. They chain their money to weak positions and then wonder why they never have enough to buy strength. They forget that every dollar is a soldier, and if you send your soldiers into a hopeless battle, they can't be fighting in the winning campaign. Have you ever found yourself sitting on a losing stock, telling yourself it'll come back, while at the same time watching another stock run away without you? That's the price of failing to free your capital. When I say cutting losers frees capital, I don't just mean money, I mean opportunity. In the market, money and opportunity are the same thing. If your capital is tied up in a stock that refuses to move, or worse, one that drifts lower day after day, you're paralyzed. You can't take the next setup. You can't move with the market's strength. You become a prisoner of your own bad trade. Does that sound like trading to you? Or does it sound like waiting for a pardon that may never come? I learned early that the market doesn't reward loyalty. A stock isn't your friend, and it doesn't care that you've been holding it for weeks, months, or even years. It doesn't owe you a reversal, and it doesn't owe you a profit. Yet most traders behave as if their stocks have obligations to them. They hold losers, waiting for them to turn around, because they can't stand the thought of taking the loss. Meanwhile, stronger opportunities pass them by, and their capital rots away in dead ground. What sense does that make? Capital is like water, it must flow to where it can do the most good. If you dam it up in a stagnant pool, it breeds nothing but decay. But if you release it and let it run toward fertile ground, it brings life, growth, and abundance. That's how your money should work in the market. The moment you realize a position is a loser, you cut it, and you redirect that money into strength. You don't cling to the dead, you move on to the living. Isn't that how fortunes are built, by riding vitality, not dead weight? Consider this: every market has leaders and laggards. The leaders are the stocks making new highs, breaking out on volume, showing power. The laggards are the ones stuck in ranges, sliding lower, showing weakness. If your capital is stuck in laggards, you're missing the leaders. And the leaders are where the big money is made. Cutting losers is not just about avoiding pain, it's about seizing opportunity. You cannot do both at the same time. You can't hold deadwood and climb on the rocket ship. You must choose. And the only way to choose correctly is to cut. I remember times when I sat stubbornly in a stock that wouldn't move. I'd watch it sag, hoping, praying, waiting for life. And then, on the same tape, another stock would come alive, running straight out of a base. But I had no money to take it. I was chained to my dead position. By the time I finally gave up, the leader had already doubled, and I was left with nothing but regret. That regret was more bitter than the loss itself. That was when I swore I would never again let dead money keep me from the living trade. Have you ever felt that sting, the sting of missing the obvious winner because you refused to let go of the obvious loser? There's a mental trap in this too. When your money is tied up in a loser, you're constantly watching it, hoping for a miracle. It eats your attention, your energy, your focus. Meanwhile, you're blind to the real opportunities flashing across the tape. It's not just your money that's trapped, it's your mind. And the longer you sit, the deeper the trap becomes. That's why cutting losers is an act of liberation. It frees not only your capital, but also your attention, so you can focus on strength. Isn't trading about clarity of mind as much as clarity of chart? Strong trades have a way of rewarding the capital that joins them. Weak trades have a way of punishing the capital that clings to them. This is the law of the market. Money flows to strength. The great operators, the big players, they don't waste time nursing weak positions. They redeploy constantly, always pushing capital toward what's moving, what's alive. That's how they stay ahead. And yet, the small trader, the amateur, will hold a dead stock for months, even years, while wondering why his account never grows. Isn't that the very definition of misplaced loyalty? Think about the power of compounding. $1 tied up in a loser earns nothing, but $1 put into a strong trend can double, triple, even more if you let it ride. The difference over time is enormous. One trader sits with dead money and stagnates, while another trader cuts the dead and rides the living, and he compounds his way to fortune. The gap grows wider every year, until the first man wonders how the second man became rich while he remained stuck. The answer is simple: capital allocation. One freed his soldiers. The other left them to die in a lost battle. Which man are you? The act of cutting losers also strengthens your discipline. Every time you make that cut, you remind yourself, my capital is too valuable to waste. You affirm that you are in charge, not your emotions. You prove that you have the nerve to act when others hesitate, and each time you redeploy into strength, you increase the odds that your money is working where the real gains are being made. Isn't that the job of a trader, to keep his money working, not sitting? Some men say they can't cut their losers because they don't want to lock in the loss. But the loss is already there. It exists the moment the price moves against you. By refusing to cut, you don't erase the loss, you only risk making it larger. And while you're holding, your money is locked away, unavailable for better trades. It's like leaving your best tools rusting in the shed while you work with broken ones. Would any craftsman do that? Then why do traders do it with their capital? Capital must be treated with respect. It is your inventory, your lifeblood, your only weapon in the market. To waste it on weak trades is an insult to yourself. To free it from losers and place it in strength is an act of wisdom. The great truth is this: it isn't enough to avoid losing, you must actively pursue winning. And you can't pursue winning if your capital is tied down in losses. I once heard a man say, "But what if I sell and then the stock comes back?" My answer was simple: so what? If it comes back, you can always buy again. Nothing prevents you from re-entering a trade that proves itself later. But if you refuse to cut and the stock never comes back, you've chained yourself to a sinking ship. Isn't it better to step off early, even if you must pay a small fare, than to go down with the wreck? Every time you cut a loser, you create flexibility. Flexibility is life in trading. It allows you to pivot when the market pivots, to move with the tide instead of against it. It gives you options, and options are everything. A trader without capital has no options. A trader with free capital can seize any opportunity that appears. That's why I say cutting losers frees capital to ride stronger trades. Because in the end, the strongest trades are the only ones that matter. Survival in markets is defense first, growth follows from offense. That rule has saved more men from ruin than any chart pattern or clever system ever could. The ordinary trader believes his job is to find the big winning trade, the home run, the single stroke of luck that will change his fortune. But the truth is simpler and far less glamorous. Your first job in this business is not to get rich, it is to stay alive. Without survival, there can be no growth. Without defense, there can be no offense. How many traders do you know who learned that lesson only after they'd blown their account to pieces? The market is like an ocean. You can't sail across it if you don't know how to weather the storms. Defense is your ship's hull. It keeps you afloat when the waves crash. Offense is your sail. It carries you forward when the wind is right. But what good is a sail if your hull is cracked? You'll sink before you ever catch the breeze. Do you see the point? A trader who neglects defense will never live long enough to enjoy offense. Defense in trading means strict risk management. It means cutting losses before they grow, sizing your positions so no single trade can cripple you, and resisting the temptation to bet the farm. It means knowing that the market will always be there tomorrow, but you might not if you gamble recklessly today. Offense, by contrast, means letting profits run, pressing your advantage when you're in sync with the trend, pyramiding into strength, and riding the big moves that pay for all the little scratches. But you cannot press if you haven't preserved. You cannot attack if you have nothing left to attack with. Isn't that obvious, yet so often ignored? I've seen men with brilliant minds destroyed because they never learned defense. They could read a chart like a book. They could sense the crowd's mood before anyone else, but they refused to protect their capital. They'd hold losers too long, double down on mistakes, or risk too much on one idea. And when the market turned against them, as it always does, they were wiped out. Meanwhile, lesser men who understood defense, men with no special genius, but with discipline, survived. And because they survived, they prospered. Which would you rather be, the genius who flames out or the survivor who grows steadily richer? Survival is not glamorous. Nobody brags about the trades they cut quickly for a small loss. Nobody writes headlines about the man who stayed flat for a month while waiting for the right setup, but that's the uncelebrated work of defense. It's the quiet discipline that keeps you in the game. Offense, the big wins, the spectacular profits, that's what draws the crowd's attention. But offense is built on the foundation of defense. The man who survives long enough will eventually encounter the right conditions for offense. The bull market will come, the tape will align, the leaders will break out, and if he's preserved his capital through defense, he'll be ready to strike. Isn't that the way wealth is really built in this game? Quiet survival followed by bold action at the right moment. Think about a boxer. He doesn't just throw punches non-stop, hoping to land a knockout. He spends most of his time protecting himself, conserving energy, waiting for the opening. His defense keeps him alive through the rounds, and when the opening appears, he unleashes his offense. Trading is the same. If you attack constantly, without guarding yourself, you'll be finished by the first counterpunch. Defense buys you time. Offense rewards you when the time is right. That balance is the heart of survival and growth. Many traders confuse movement with progress. They feel that if they're not always in the market, they're missing out. So they force trades, they take marginal setups, they chase noise. That's offense without defense, wild swinging in the dark. The disciplined trader knows better. He knows that staying on the sidelines when conditions are poor is part of defense. He knows that preserving his capital during uncertain markets is as valuable as making money in favorable markets. He understands that sometimes the smartest move is no move at all. Do you have the patience for that kind of defense? Capital preservation is more than avoiding losses. It is about protecting your ability to act when the right opportunity comes. Every dollar lost unnecessarily is a soldier you won't have when the real battle begins. if you waste your capital on poor trades, you may not have the strength left to ride the big trend when it finally appears. And that's the tragedy, missing the once-in-a-year opportunity because you were crippled by a dozen foolish losses. Defense keeps your army intact. Offense is how you march to victory. But without the army, offense is impossible. Emotional survival is just as important as financial survival. A trader who suffers a devastating loss often loses more than money. He loses confidence, discipline, and clarity. He hesitates, he second-guesses, he either freezes or he overcompensates. That's why big losses are so dangerous. They destroy the very mindset you need to trade well. Small, controlled losses, on the other hand, don't shake you. They're part of the plan. They allow you to remain steady, calm, and prepared. Defense of your mind is just as vital as defense of your money. How long can a shaken man keep trading effectively? Not long. Growth, the offensive side of trading, only happens after defense has done its job. When you're safe, when your capital is intact, when your mind is calm, then you can press your advantage. Then you can let profits run, add to winning positions, and ride the big waves. Offense without defense is reckless gambling. Defense without offense is stagnation. You know, the market has a way of teaching a man more about himself than he ever cared to know. I've always said the stock market is never wrong, but the men who trade it almost always are. And when I look at the mistakes that wipe out traders, whether they're green beginners or veterans who should know better, it comes down to two things: greed and bleeding money. If you don't learn to control those, the market will do the teaching for you, and the tuition is mighty expensive. Tell me, have you ever been in a trade that was working out just fine, giving you a nice profit, and instead of taking it when you should, you held on, hoping for just a little more? You thought, it's moving so well, maybe I'll double it, maybe it'll run forever. And then what happened? The market turned, as it always does when you least expect it, and that paper gain you could have cashed out with pride turned into a loss that hurt like a knife. That's greed. That's the enemy. Now, I never knew a man who went broke taking profits, but I've known plenty who ruined themselves waiting for a profit to grow into a fortune while ignoring the simple fact that the trend was already done. You've got to remember, the market doesn't owe you a thing. It will not reward your hope or your wish. It pays only on judgment, patience, and discipline. Do you have the nerve to step aside when the tape tells you it's over? That's the real test. And here's the thing about bleeding money. Every trader who ever lasted more than a season learned this. You can't sit and hope your losses come back. That's the quickest way to bankruptcy. The public does it all the time. They buy a stock, it drops. They say, well, it's just temporary, I'll hold on. The stock drops further, and they say, it's cheap now, I'll buy more, lower my average. And they keep doing that until the stock isn't a trade anymore, it's a disease. The bleeding gets worse, and the patient doesn't survive. Why let yourself bleed? If you cut your losses quick, they stay small. But when you hesitate, when you convince yourself that it'll turn around, that's when the market takes your whole pocketbook. The very first loss is the best loss, if it keeps you alive for the next trade. Have you thought about that, whether you'd still be in the game today if you had just cut that one bad trade when it first went against you? I learned early that money isn't made in constant trading. It's made in sitting tight when you're right and cutting quick when you're wrong. The big money is in the big swing, not in scalping every little move. But greed gets in the way, doesn't it? A man thinks, I'll just squeeze another point, another tick. That's how a profit trade turns into a loss. The market doesn't whisper in your ear when it's done. It just turns, and if you're greedy, you're the last to notice. Now, look at the charts. They don't lie. The price action is the only truth in this game. When a stock breaks out of a base on strong volume, that's the market's way of speaking. When it rolls over, making lower highs, losing its momentum, that's another message. Do you listen, or do you talk back? Most traders talk back. They argue with the tape. They say, it can't go down further. It's already dropped too much. That's the surest way to keep bleeding. Let me ask you, do you treat your trading capital like a soldier treats his ammunition. Because that's what it is. Every dollar you lose unnecessarily is a bullet you won't have for the real fight. Bleeding money isn't just about losses on paper. It's about losing the chance to act when the right setup comes. And the right setup doesn't wait around for you to nurse your wounds. It shows up, it demands readiness, and if you're strapped from trying to recover losses, you miss it. That's worse than the loss itself. Greed. Now greed makes a man chase tips, chase rumors, chase stocks that have already made their move. It makes him buy when he should be patient and hold when he should be selling. Greed whispers, "This one will make you rich if you just hang on." But the truth is, in this game, you don't get rich quick, you get broke quick. Do you remember the last time you chased a runaway stock? You thought you were jumping on a train going to the moon, and all you caught was the last stop before the crash. That's what greed does. I always kept to this: never average down, never add to a losing position. That's not trading, that's gambling. That's putting good money after bad and calling it strategy. When a trade goes against you, the market is telling you you're wrong, and the market is always right. The only choice is to accept it, take the loss, and move on. Do you want to trade to prove you're right, or trade to make money? Because you can't have both. And here's the secret most don't want to hear: wealth in trading doesn't come from hitting every move. It comes from preserving your stake, from letting the market show its hand, from taking only the clean, high-probability setups. The rest is noise. But the trouble is, noise feels like action. Greed feeds on noise, makes a man think he's missing out if he isn't trading all day, every day. The truth is, the best trades often come after long waiting. Can you sit on your hands while others chase? Or does your greed drive you into bleeding money on low-quality trades? I've seen men ruin themselves not from lack of brains, but from lack of control. A man can be brilliant, read every chart perfectly, and still end up broke if he can't master his own impulses. That's what this really is: a game against yourself. Greed makes you blind, and bleeding money makes you desperate. Desperation is the worst trading partner you can have. Do you notice how your judgment changes after a bad loss? You start seeing setups that aren't really there. You start forcing trades, not waiting for the right ones. That's bleeding money through the mind as much as through the account. Look back at your trades. Do you know how many of your losses came because you didn't listen to the chart but listened to your own hopes instead? I'd wager it's most of them. The chart is clean. It's unemotional. It says exactly what's happening. But greed and fear put words in its mouth, make you see what isn't there. You say, "This stock has to bounce." The chart says it's breaking down. Which one is right? The chart never lies. And when you control greed, something remarkable happens. You start to see the market clearer. You stop chasing, you stop forcing, and you start waiting. That waiting, that patience, is what separates the successful trader from the poor fool who can't stop bleeding money. But here's the hard truth: patience feels like doing nothing, and most men can't stand doing nothing. That's why they fail. Do you have the stomach to do nothing when nothing should be done? I've always said that trading is simple, but it isn't easy. The rules aren't complicated. Cut losses. Let winners run. Follow the trend. Don't fight the tape. But simple rules don't make them easy to follow, because the enemy isn't the market, it's your own nature. The market only reflects what you are willing or unwilling to control. Greed is inside you, not in the chart. Bleeding money is the result of choices, not of chance. Do you see that yet? Think of it this way: every dollar you save by cutting losses quick is another chance to ride a winner when it comes. Every trade you don't take out of greed is one less mistake you'll have to pay for. The man who lasts in this business isn't the one who grabs every profit. It's the one who avoids destruction. That's the real secret: not making money, but keeping it. Have you thought about how much richer you'd already be if you had just kept what you once made? Desperation is the quiet killer in this business. It doesn't walk into your trading room and announce itself. It sneaks in after a string of losses when your confidence is shaken and your judgment is blurred. You take a hit, maybe two, and suddenly your whole approach shifts. You don't even notice it at first. You're still sitting at the same desk, looking at the same charts, but now the way you see them is different. What was clear and obvious before becomes cloudy. Patterns you would have ignored suddenly look attractive. Setups you would have judged too weak now seem good enough. Why? Because you're desperate to win it back. That desperation makes you act when you should be waiting. It makes you force trades, and forced trades almost always end the same way: more losses. Tell me, have you ever caught yourself clicking buy or sell, not because the chart was screaming an opportunity, but because you just couldn't stand the thought of sitting out after a bad day? That's desperation. It whispers in your ear, one more trade, and you'll get it all back. But the market doesn't care what you lost yesterday, and it certainly won't pay you back out of pity. All it does is show you a new set of prices today. If your judgment is clouded, if you're chasing out a frustration, the market will make you pay for it, same as always. When a trader is desperate, he doesn't follow his plan. He can't. His plan feels too slow, too cautious. He convinces himself that extraordinary effort will fix the problem. So he takes extraordinary risks. He doubles his size, he enters without confirmation. He ignores the stop loss he swore he'd never violate. And in those moments, he tells himself it's necessary. He tells himself it's the only way. But deep down, he knows it's just a gamble, and gamblers don't last long in the market. Have you ever watched yourself break every rule you set, while at the same time trying to justify it? That's the face of desperation in trading. Now, let's be honest about what creates this state of mind. It's not just the money, it's pride. Losses hit your pocketbook, but they hit your ego harder. You start to feel like the market is mocking you, like it's personal. You don't want to walk away with a defeat on the day, so you fight back. You start trading not to make money, but to get even. And that, my friend, is the most expensive kind of trading there is. The market has no memory, but you do. And your memory of the loss poisons your ability to see clearly. That's how bleeding money accelerates, not through one big mistake, but through a series of desperate little ones. Think back to the times you dug yourself into a hole. Wasn't it after you tried to fix a bad trade with another, and then another? Each time, you told yourself, just one more trade and I'll be back to even. But instead of even, you sank lower. The hole got deeper. That's because desperation isn't strategy. It's emotion. And emotion has no edge in the market. The chart doesn't reward your need. It only rewards discipline. And discipline is the one thing desperation robs from you. What makes desperation so dangerous is how quickly it spreads into every decision. You might start out with one small mistake. Maybe you moved your stop a little farther than you planned. Just this once, you say, but then the market goes further against you, and you tell yourself you'll hold a little longer because you can't take the loss here. Suddenly, you're sitting in a position you never should have taken, at a size you never should have used, with a loss you can't accept. That's how traders blow up. It doesn't happen in one grand act of foolishness. It happens through a chain of desperate little compromises. Have you noticed how easy it is to compromise when you're already hurting? And don't think desperation only comes after losses. It comes after missed opportunities too. A stock you wanted to buy breaks out and you hesitate. It runs without you. You kick yourself, and now you feel behind. So you jump into the next thing you see, not because it's a good setup, but because you're desperate not to miss again. That trade fails, and now you're bleeding from a wound you never should have opened in the first place. Missing a trade doesn't cost you money. Chasing out of desperation afterward does. You have to understand, the market is a place where patience is punished less than desperation. Waiting may feel uncomfortable, but it keeps your powder dry. Desperation, on the other hand, drains your account and your confidence. Once you've bled enough, you stop thinking like a trader altogether. You start thinking like a gambler at the roulette wheel, throwing chips just to feel alive. And the market loves nothing more than a desperate gambler. It feeds on them every single day. The hardest thing to admit is that desperation is self-inflicted. The market doesn't force you to act. The tape doesn't beg you to trade. You press the button yourself, and when you do it for the wrong reasons, you have nobody to blame but the man in the mirror. That's a bitter truth, but it's also the key to freedom, because if desperation is self-inflicted, it can also be self-controlled. You can decide to step back, to stop trading when you're not clear-headed. The problem is, few traders ever do. They let the pressure drive them instead of mastering it. Do you ever give yourself permission to just stop for the day after a bad loss, or do you keep throwing yourself into the fire? The best traders I've known weren't the ones with the most brilliant analysis or the fanciest indicators. They were the ones who knew when not to trade. They could feel desperation creeping in, and instead of feeding it, they shut it down. They walked away, cleared their head, came back when they could see straight again. That's what kept them alive. That's why they had money left when the real opportunities came. And that's why most others didn't. Desperation is like quicksand. The more you struggle against it, the deeper you sink. The only way out is to stop thrashing. You stop forcing. You stop trying to make the market give you back what it took. You let go of the need to be right today, and you wait for tomorrow. But waiting is hard. It feels like surrender. That's why so many traders can't do it. They confuse patience with weakness, and in doing so, they trade themselves right into ruin. The truth is, the market will always be here tomorrow. There will always be another setup, another trend, another chance. But you won't be here if you've blown yourself up today out of desperation. Protecting your capital means protecting your state of mind. When you're clear, you can see the tape for what it is. When you're desperate, you see only what you need it to be. And that's the most dangerous blindness there is. Do you know what separates a temporary setback from a permanent failure? It's whether you let desperation take over after the setback. Every trader takes losses. That's part of the game. But not every trader lets those losses turn into desperation, and not every trader tries to claw it all back at once. The ones who do are the ones who bleed out, who never recover, who leave the market with empty pockets and empty spirits. The ones who resist, who control themselves, they live to trade another day. Greed has ruined more traders than ignorance ever could. A man can read the tape perfectly, follow the trend, and have the right stock at the right time, yet still walk away broke because he couldn't control the urge to hold on just a little longer. You know what I mean, don't you? You're in a trade, it's moving your way. The profit is right there in front of you. You could take it and call it a day, but something inside whispers, wait, don't sell yet. There's more to come. Why settle for this when you can have more? That whisper is greed, and it's as dangerous as any trap the market lays out. I've always said the market gives you chances, but it doesn't give you guarantees. When you have a profit, that profit is yours only if you take it. Otherwise, it's just numbers on paper, ready to vanish as soon as the tape changes direction. How many times have you seen a strong position collapse in front of your eyes because you didn't lock it in? How many times did you think, just a little higher, just one more point, only to watch the trend reverse and take it all away? Every trader has felt that sting. It's the tax greed charges, and it's often far higher than the profit you are chasing. You have to understand that greed blinds you to the signals the market is already giving. The chart starts to show exhaustion, volume dries up, momentum weakens, maybe a reversal bar appears. Those are warnings, but greed doesn't let you hear them. Greed convinces you the move is only pausing, that the rally still has legs, that this time is different. It tells you to ignore your own rules, to dismiss the signs that have guided you before. And once you silence your rules, the market doesn't hesitate, it takes back what it gave you. Have you noticed how every time you ignore the chart in favor of just a little more, it ends badly? Here's the truth most traders don't want to face. The big moves don't come every day, and they don't stretch forever. Every trend has an end. Your job is not to milk every last tick from it. Your job is to ride it until the odds shift, then step off before the turn. But greed tells you the end is farther than it really is. Greed whispers that you're leaving money on the table if you sell too soon. And that whisper makes you hold, and hold again, until the profit shrinks and then disappears. A professional trader isn't measured by how much he makes on his best trade, he's measured by how much of those profits he keeps. Think of it this way: the difference between a winning trade and a losing trade is often nothing more than timing. You might have picked the right stock, caught the right entry, and sat through the right move. But if you don't sell when the time is ripe, you might as well have been wrong from the start. The market doesn't pay for being right on direction alone, it pays for being right on both direction and timing. And greed is the great enemy of timing. Do you remember the last time you were right about everything except when to sell? That's greed's fingerprint. Now, there's nothing wrong with holding on to a trend when the signs say it still has life. That's discipline, and that's how you make real money. The trouble starts when you hold after the signs have changed, when you refuse to take what's already a healthy gain because you want more than the market is willing to give. I've seen men take a 10-point profit and turn it into a 10-point loss, all because they couldn't stand the thought of leaving money on the table. Leaving money on the table is never as costly as losing the money you already had in your hand. Do you believe that yet, or are you still chasing every last tick? Greed also tricks you into changing your plan mid-trade. You went in with a target, maybe a level of resistance you'd sell at, or a percentage gain that fit your system. The stock reaches the target, and instead of selling, you tell yourself, "It looks strong, I'll hold a little longer." But that wasn't your plan. That was your impulse. The moment you abandon the plan, you're no longer trading, you're gambling. The market isn't fooled by your justifications. It doesn't reward wishful thinking. It rewards discipline. And discipline means doing what you said you would, not what you suddenly feel like. How many times have you broken your own rules out of greed, only to regret it afterward? And here's the cruel irony: greed doesn't just make you lose money, it makes you lose peace of mind. When you're greedy, you can't enjoy your gains. You're always restless, always thinking about what you could have made if you'd held longer, or if you'd added more size. That restlessness eats away at you. Even when you book a profit, it feels small, unsatisfying, because greed has raised your expectations beyond reason. So you take bigger risks, stretch your trades further, and eventually the market humbles you. That cycle repeats until you either learn control or quit the game altogether. I want you to think about how many great fortunes have been lost not because of bad stock selection, but because of bad selling. Buying is easy. Any fool can buy. Selling is hard, because selling requires judgment, patience, and above all, humility. It requires admitting that the move is done and that you've taken enough. Greed makes humility impossible. Greed tells you there's no such thing as enough. But the market punishes that attitude every single time. Can you honestly say you've ever grown your account by being greedy, or has it always ended with the market taking back more than you gave? Another danger of greed is how it makes you blind to opportunity. You sit in a stock that's already run its course, squeezing it for one more uptick, while elsewhere a fresh trend is just beginning. But you're too tied to your current trade to see it. By the time you admit the move is over, you've lost the profit you had and missed the new chance too. That's the double cost of greed: lost gains and lost opportunities. A disciplined trader lets go of the old to be ready for the new. A greedy trader clings to what's fading and ends up with nothing. Do you want to be ready when the next real move starts, or stuck in a dead trade because you couldn't let go? Greed can even show up in small ways that seem harmless. Maybe you set a sell limit and the stock misses it by a few cents before reversing. You curse yourself for not adjusting, for not grabbing the near miss. But why did you need the exact number? Because greed wanted perfection. It wasn't satisfied with a near target profit. It demanded the exact top. And in chasing that perfection, you end up giving back more than you should. Trading is not about perfection. It's about consistency. Greed doesn't understand consistency, it only understands more. The wise trader learns that enough is enough. He learns to take his profits according to plan and move on. He knows the market will always provide another chance, another swing, another trend. He doesn't need to wring the last drop out of every trade. He just needs to keep his gains and protect his capital. But most traders never learn that lesson until the market teaches it to them in the harshest way. And the tuition is always high, because greed doesn't go away with one loss. It lingers. It tempts. It tests you again and again. The question is, how many lessons will you pay for before you finally control it? Wealth in trading doesn't come from constant action. That's the hardest truth for most traders to accept. A man sits in front of his screen all day, watching prices flicker, feeling that urge to be involved, to always have a position, to always be doing something. He convinces himself that activity equals progress. But activity without judgment only equals losses. It's not the number of trades you make that builds wealth. It's the quality of the trades you take and the ability to keep the money once you've earned it. Do you really think the market cares how hard you work or how many buttons you press in a day? It doesn't. The market only pays out to those who act at the right time and then protect what they've made. I've seen men who couldn't stand still, who had to be in every little move, every tick up and down. They traded morning, afternoon and night, and do you know what they ended with? A broker's bill and a broken account. The commissions ate them, the bad trades wore them down, and whatever small profits they grabbed vanished in the noise. Then I've seen other men, quiet men, who waited, who maybe made only a handful of trades in a month, but when they struck big, and they kept their winnings. Which of those two do you think built lasting wealth? The trouble is, most people think making money in markets is about always being right. They think if they're not constantly proving themselves, they're failing. But the real skill isn't being right all the time. It's protecting your stake long enough to be right when it truly counts. The great moves, the ones that can change your account and your life, come rarely. They come when a stock breaks out cleanly, when a market shifts trend decisively. If you're worn down from bleeding money in constant little trades, you won't have the capital or the nerve to take the big one when it appears. How many times have you missed the real move because you were too busy fighting in the small ones? Wealth is about keeping. It's not what you make on paper, it's what stays in your account after the noise is over. That's why discipline is more valuable than cleverness. A clever man can call every twist and turn, but if he can't hold on to his profits, he ends up broke. A disciplined man may not be right as often, but when he is, he takes the profit and guards it like gold. He doesn't give it back out of boredom or greed. He understands that the market will not stop offering chances, but his capital can stop if he wastes it. Do you look at your profits as something fragile to be protected, or do you treat them like they'll always come back if you lose them? The worst kind of bleeding isn't losing money on a bad trade, it's giving back money you already earned. Nothing cuts deeper than watching profits dissolve because you couldn't sit tight, because you needed to do something, anything, instead of waiting. That's why so many traders never build wealth. They're too busy recycling the same dollars in and out of the market, never letting them grow. Imagine if you had simply kept half of what you once made instead of trading it away again. Where would your account be now? Wealth grows in stillness as much as in action. Sitting out, holding cash, waiting for the right setup that feels like wasted time to an impatient trader, but it's the only way to stay ready for the opportunities that matter. The truth is, the market doesn't reward the busiest trader, it rewards the most selective. The man who can say no to 9 trades out of 10 and only swing at the fat pitch is the man who gets paid. But saying no is uncomfortable. It feels like missing out. That discomfort is why most traders fail. They want the thrill of constant action more than they want wealth. Do you want excitement, or do you want money? Because you rarely get both in this business. Keeping wealth also means resisting the urge to scale up too fast. Greed makes you press the gas when you should still be cautious. You make a few good trades, you feel invincible, so you double your size, triple your risk. Then the market gives you a normal correction, and suddenly all those winnings and more are gone. That's not wealth, that's gambling. The wealthy trader increases his size slowly, in proportion to his actual gains, not his fantasies. He protects his bankroll first, grows it second. How often have you seen someone win big and then lose it all because they couldn't slow down? There's another point to wealth. In trading is about mindset as much as money. A trader who sees every profit as fuel for the next gamble never builds anything lasting. A trader who sees every profit as a foundation to be guarded, brick by brick, builds something permanent. The difference isn't in the trades themselves, it's in what you do after the trade. Do you bank the money and strengthen your position, or do you throw it right back on the table in hopes of a bigger score? Look at the men who lasted decades in this game. They weren't the loud ones, the ones chasing every tip or every flicker on the tape. They were the quiet ones, who didn't need to trade every day, who didn't feel less of a trader for sitting in cash. They knew wealth wasn't in the noise, it was in the big moves, and in not losing it afterward. They learned to accept boredom. They learned to embrace the quiet, and that's why they could ride the storm when it came. Can you sit in boredom without forcing a trade, or does the silence push you into mistakes? The market has a way of punishing impatience. You chase small moves out of boredom and you bleed. Then, when the real move comes, you hesitate because you're already bruised, already short on capital, already doubting yourself. That's how opportunity slips by. Wealth isn't just about having the right stock, it's about being in the right condition when the stock appears. The condition of your capital, the condition of your nerves, the condition of your discipline, all of that matters. Desperation and overtrading rob you of those conditions, and without them, you can't capture wealth, even when it's right in front of you. And let's not forget the temptation to withdraw too early. Some traders cash out every small win, treating the market like a paycheck, instead of letting the account compound. They never let wealth build because they're too focused on quick gratification. The real growth comes from holding on to your profits, adding them to your stake, and using that larger stake wisely when the big opportunity comes. But greed doesn't see compounding, it only sees today's craving. And impatience eats away at tomorrow's fortune. So wealth in trading isn't just about winning trades. It's about building a reservoir and keeping it intact.